As you can see, it's just an example to start things up and to get your interest in the right way. I have put on 2 stages of our ZL trade, soybean oil, one of the markets that we traded this week. 2 stages, one April 19, 11 a.m. before the breakout. This is something that premium members were aware of or were notified of in due course. And then a couple of days later, where we have broken out and we were approaching 1R. A third stage, if you look at the ZL market right now, you know that we are 2 days past and things have happened since then also. This is a typical example, just if you look at it visually, regardless of the market, regardless of the time frame, this is what our chart looks like. Visually, all our charts are the same. They're clean, zen, beautiful simplicity. If it's not on our chart, it's not on our charts because we don't really need it. And if it's on our chart, it's on our chart because we use it for trading. And so this is what it looks like. You also see the 1R, which means that the reward and the risk is the same distance from our entry, and that's indicated by those colored lines in NinjaTrader. This is the third stage. This was yesterday, so you can see that this particular trade, again, these are the stages of the trades that we're looking for. And as you can see, more often than not, we are able to identify the opportunity before things happen. Now, I'm not saying that every time we identify a potential opportunity or an opportunity, trades will hit the 1R. No, actually, on corn, you may recall if you were on premium, we dropped an entry because it never triggered. Sometimes it does trigger and then it falls back, and then we have to manage our way out of the trade, of a non-performing trade, with the least damage possible. But please note, we always look at the level of automation as a spectrum from, let's say, totally manual to totally automated. And in real life, I don't think anybody is really at the 2 extreme ends, although I'm not saying it's not possible, but most people are somewhere in the middle. And we have talked about this particular topic in previous videos, so you can go back and check them out. The point is that what level of automation you assign to our software within your trading activities is really up to you, and much depends on your circumstances. This is the point where things get a little bit personal in everybody's life, depending on, work schedule, family, wealth, even time zone, age, whatever, hobbies, pets. There's so many things that influence our daily schedule. Having said that, depending or regardless of the level of automation, the job is clear. Whether you do this with BT or Pro STR or even totally manual, it's up to you. But the opportunity, the trade doesn't care. Price doesn't care if you're in it or if you're not in it. The move doesn't care. So however you decide to perform the trade or execute the trade is up to you. We do provide the software to make this work as easy as possible. Optionally, if you want, we can look at the current situation on the indexes, currencies, metals, treasuries, and agros. These are the markets, the asset classes that we trade and which are included in our premium nightly market analysis. I'd like to say one thing, though. The way we do this work is that we always look at the futures markets. We start with the futures markets. That's where the information comes from, and we deduct information and we make a plan based on our charts in NinjaTrader, of course, on the futures market. Please note that most often we do the actual trade also on the futures, but there's no obligation to do the trades on the futures. And what I mean is, well, you can do it with micro futures contracts, of course. You can always translate a trade for better risk management in your particular situation and do the trade with micros. But please note, even if you do the trade with micros, with the appropriate micro contract, whether it's MES or MNQ or MGC or whatever that is, the information and the plan must come from the standard contract. Many people don't do this. Many people keep looking at the MNQ all day, like slippage and stuff like that is very different on the micro contracts. And it's much easier for professional traders to move price around and stop people out on the micro contracts. But if you look at the standard contract, probably some of the moves never happen on the standard contract because it would take 10 times more money to make the same move. Understand what the micros, how the micros work and what the differences are between the micros and the standard contract, and always make your plan based on the standard contract. Now, in practical terms, if I do this, I have, let's say on the left side, I have an NQ chart, and I look at the NQ and I make the plan. And if I happen to have not enough money to do this, to execute the plan on the NQ, then it's by all means, it's perfectly fine to execute the trade on the MNQ. But please note that the idea and the specifics of the trade must come from the NQ, the standard contract. First step is to identify the opportunity. The second step is to structure a trade based upon that opportunity. Just an example, what we do and on which asset class we do it may change or shift throughout the year, depending on the opportunities that present themselves. Currently, we see excellent opportunities on currencies and less so on the indexes. This could change, of course, but I'm confident that when it changes, if it changes, we'll know about it. Now, jumping on the currency market, we have identified the weakening USD months and months ago. You can go back into the premium video archives, which every night's video is stored and left as it was for better or worse. So whatever we said when we said it, it's recorded for posterity, and we were talking about potential long trades on major pairs meaning the major currency pairs, ever since, remember when the first failure test emerged on the Swiss franc? It's in the videos. As soon as that failure test on the weekly was identified, we said that from this point on, we'll be actively looking for longs on major pairs. And we've been active on 6E, the Australian dollar and Swiss franc, and the Japanese yen as well. This is the failure test that we identified. When was this? Let me check. In February, when we started to trade currencies. A failure test is a situation which is a strong price rejection, which often results in a strong move in the other direction. And this is exactly what happened on this chart. Just look at the Swiss franc, the action since February to the past 2 months. This is a weekly chart. You can translate this strong move. Of course, we didn't know that this would be this strong. What we knew at the time is that we can expect some long trades. Now, you may recall, if you were with me, that when was this day? This is April 2nd. We were on this full force before it broke. Not because we are so smart, but because, well, we are smart, but not because we are in any way special, but because we identified a typical market behavior over the years, which is the reemergence of momentum. We have built a software that captures it. We can do the math. Now, of course, nobody knew this would be this strong. So if it gets to 1R, you take your profits, you look for the next opportunity, or you look at some other markets. I'd like to say one word about the 6E. If you ever decide to specialize in currencies, either get the DX in your data feed, or if you do not have the DX in your data feed, then simply use the 6E as your guide as to what to do on currencies in general. And the reason for that is that the 6E is the biggest ingredient in the DX basket. Therefore, what it means for us in practical terms, that if you put on the 6E chart, and if you put the DX chart next to it, it would be almost a mirror image. And what that means is that just by looking at the 6E, you can know where the dollar is most likely going. And if you know where the US dollar is most likely going compared to other currencies, then you can start looking at other currencies. All right, so if you see this big bull flag on the 6E, then you can expect that the 6E is strengthening against the USD. USD is weakening, which means it's worth looking at other currencies and look for longs as well. Now, they're not in the same phase all the time. You can see just a quick look at the 6E and the Australian dollar shows that the 6E is much more advanced. The 6E has already conquered this important previous pivot. If you look at the 6A, it's a very different geographic and economic environment, of course, Australia and Europe. But nonetheless, you can see that there is a breakout area and there is a previous pivot. Price probably, or in most likelihood, will revisit, if not the previous pivot, at least the area. A step back to 6E, you see that this distance has already been covered by the 6E, but not yet by the 6A. This is what we call correlation trading. The correlation is a little bit loose. I'm not saying it's strict between the 6E and the 6A. Of course, it's not strict, but nonetheless, it can provide us with some very useful clues, especially if the technical structure is something that we recognize. This 6A chart actually does make sense to me. I do recognize this situation. This situation, pressure into resistance, is in my trading plan. The reemergence of momentum is in my trading plan. So, of course, I am paying attention. Actually, I might as well be positioned to the long side, because if I look at smaller charts, I can see that the 4-hour chart is getting ready. And for that matter, our algorithmic mathematical calculations are doing what they're doing so well. 3 long signals, not to mention the famous Remek cloud, which is a objective measurement of momentum widening, pointing to the upside. So this is what I see on the 6A. Not surprisingly, other major pairs are doing something similar. Just a quick look at the British pound. I would safely disregard this short signal here. In this case, there's no obligation to trade it. By the way, let me just point this out because I had a question this week, and this is, I think, important. When you trade, let's just imagine for 1 second that you're a completely algorithmic trader. In that case, your machine, if you're on the 4-hour chart, your machine would take this short. And here's the point I'm trying to make here, is that if you look at our quantitative tests, which we published on YouTube in much detail, do contain these trades, which as a human being, most likely you would not be inclined to take. See the point? So our algorithmic tests, our strict machine-driven, totally automated backtesting results are positive. And they obviously include trades like this, which you would possibly skip as a human being, as an experienced trader. It just slipped through. It just gave us a yes. And the point is that even with those rotten apples, even with those obviously not very likely well-performing trades, our results are positive. And if you filter out some of the obviously not really preferable trades, like this one here on the 4-hour, then in my experience, you can improve greatly on the machine-driven results that the algorithm would give you if you never touch the mouse. Now, some traders still decide to let the machine do it and be content with the results that the machine gives them, and that's fine too. Then a quick look at the New Zealand dollar, which is correlated with the Australian, and correlation can add great value to our edge. It can be applied on currencies, just like what we're looking at now. The 6N moves in a very similar way with the Australian dollar. Actually, you can see that the 6N has already done what the 6A hasn't done yet. Look at the chart. We have the previous pivot. We have the breakout area, and what do you see? The 6N has already broken out a few days ago. If you go back to the 6A, same chart, very similar chart, except that this move hasn't happened yet. The 6N is somewhere here already. The 6A, not yet. Is that a piece of information that could help us? Of course, because the 6A is likely to do next what the 6N has already done. As always in trading, everything or anything I say, there's never a 100% guarantee. Is it possible that the 6N will be down here tomorrow or the 6A? Of course it's possible. Everything is possible, but it's not likely. Correlation trading, you can use it on treasuries, you can use it on currencies, on precious metals, and everybody knows on the indexes as well. All right, let's move on to some other asset classes quickly and say just one word about gold. We've been on gold forever, and but the past doesn't matter now. Where we are now is we hit 3,500. We can see the top tail on the weekly. Think trading gold if you haven't yet, but not right now. We have to wait for a setup. Right now, this is not the time, as one quick look at the chart shows, to start putting on long trades. However, silver, talking about correlation, silver is acting somewhat strange and unexpected ways. Historically, there's a strong correlation between gold and silver, and what you see is that what gold has done already, silver hasn't done yet. So I do expect that silver will make a move towards the upside. If you look at the weekly chart, 35 is an important resistance. Silver has been struggling or fighting or testing this level several times, roughly this area here, and 1, 2, 3, 4, 5 times. And the more times we revisit this level, the more likely it will break. So I think one way or the other, nobody knows exactly how and when, but I think this breakout is likely to occur. If we know this, if we see this as an opportunity, not as a guarantee, but as an opportunity, what are we going to do about it? And that the answer is individual. It must be, because our circumstances are not the same. So that's why, just a more general remark, it is pointless to try to copy somebody. That just doesn't work in trading. I know many people say, just do the trades that I do. It never works because our situation will be different. Our strengths and weaknesses will be different. So you have to, I might tell you in my nightly videos that I do expect to eventually, one way or the other, silver to retest the $50 level. Why? Because I was sitting in this same chair when silver hit 50 in 2011. April 30, 2011, we hit 50 on silver. Now we're 15 years later. Look at this. Gold is already well beyond the level where it was in 2011. In 2011, gold was 2,000. Well, now we're 3,500. But silver, for some reason, is still spending time here at 35. So much about precious metals. Let me say one word about treasuries. Everybody noticed who looked at treasuries lately that we had a very strange move a few days ago, and which may have been the result of some large player intervention. If you want, just Google treasuries Japan, something like that on Google, and you'll get to the story within 10 seconds. The treasury markets are a little strange and unpredictable, so I would avoid them for now. This is the action that I mean. This was very uncharacteristic. This sudden overnight drop lasting, not just overnight, but lasting several days. Okay, it looks better now. Keeps me away from the treasury market right now. Okay, and then finally, one of our success stories this week, the evolution of a trade on the ZL. Our premium users knew about this breakout area. Look at these two long signals, and then we easily hit the 1 hour. And this is a chart which I want to mention when we talk about the 1 hour topic, which is actually coming up next. April 19, before the breakout. April 24, after the breakout. Then we hit 1R, which is where we take our profits, and then see what happens next. It falls back and almost gave back 50% of the move. And this is a good demonstration. And I made a comment here at the time at 1:48 p.m. on the 25th, which went out to premium members. See why it's a good idea to take at least partial profits at 1R. Be content with 1R, meaning that your reward is the same distance from your entry as your risk. It's much better to have a rule in your trading plan to, let's say, remove 50% of your profit here and tighten your stop. And you can do this with BT automatically. If you decide to perform these trades on either Pro STR, which allows you to move the mouse while in the trade, or BT, which does not allow you to move the mouse while in the trade, whichever version of our algorithm you decide to use, you can easily program it in such a way that 50% or 66% of your profit will be removed at 1R. You tighten your stop in a millisecond, and if it falls back, you're stopped out. As a general rule, if you just take 1R, perhaps keep a modest runner just in case, is a very stable way. And it results in a smoother equity curve, which helps us sleep better in the long run as traders. So the way I see this is that trading is difficult. Trading is difficult already mentally, not just putting the money together and risk the money, but also mentally and discipline-wise. But it requires rigorous discipline and objective thinking, compartmentalization, focus, all those things, a healthy life. And that's already difficult. And then intraday trading is the most difficult way to trade within the realm of trading. So long story short, I think intraday trading, in my experience, is a possible way to trade. The way my bruises tell me is that the most difficult way to trade. Also, do your own testing, but my testing have shown to me that moving to higher time frame provides a more stable edge. So two statements I can make based on my data research is that moving to higher time frame increases the probability of success in trading, and moving to lower time frames increases the amount of randomness on the market. The smaller the chart, the more random the chart is, and we can't trade a random chart. Randomness is no edge. Okay, so it's perfectly fine to think micros, which I know many of us do. But if you trade micros, always start with the standard contract. And it's perfectly fine to think ETF, but even in that case, always start with the futures contract and then translate the risk into the appropriate ETF. So there's a question about structuring the trade. This is mentioned in our documentation. So if you go to let me show it to you. If you go to our website, let me just show you the documentation quickly. If you go to, click on here, this is the user guide, user manual, in other words, documentation. If you just go in here, this is the link. You just Google it, and you'll find the section about structuring the trade. And why standalones? The standalones is programmed in such a way that no middleware is needed. So there's nothing between our product and NinjaTrader. Our product is lightning fast, and standalones just means that there's no middleware. There's nothing between us and NinjaTrader. RM Pro indicator. Yes, we do have an indicator, and we have 3 RM Pro Remek Momentum Pro strategies. If you're new to Ninja, I'm sure nobody here needs this question to be answered, but an indicator puts information on the chart. It will never enter a trade or exit the trade or manage the trade for you, obviously. Strategy, on the other hand, does everything that the indicator does, but also enters, exits, and manages trades. Lastly, if you're ever looking for something and you want to know what we think about it, let's say you're let's say you want to Google 1R, whatever the term is, then cite remek.ca, and you would Google, you're forcing Google to only search within our website. So just as an example, 1R, you will get all the blog posts over the years, and you can do your research that way. Okay, well, I hope you have found this useful, and thank you very much for your time. Enjoy your weekend, and we'll talk soon. Thank you, and mindful trading.